no blue is not enough.
Hey guys, so in this video we're going to be talking about trade management, and all that trade management is going to be what happens after you take your entry. And this just means where your stop is or is not moved to, and this also means where you take your profit and where you decide not to, or where you decide to let those winners continue to run past your target. And that's all trade management is, and I believe it's one of the most important parts of trading, because all the money is made on when you take your profit, and all the money is kept on where you get stopped out. So it's very, very important. And to talk about trade management, at least for me, you're going to have to understand some of the lingo on my charts, and it's going to be very simple. So T1, T2 is just going to be the first and second targets. Normally, I don't have more than 2 targets, or if I do have more than 2, I'm going to be trailing my stop based on a trend-based method. And we'll talk about that in a sec, but we also have BE, which just means moving break even. And normally you're going to see my first target being take your partial, move stops to break even. And when it comes to options trading, this can mean break even on the price of the underlying, meaning the stock price. So if you shorted Facebook at $100, traded to 98, hit your first target, and then moved back up to 100, that'd be a stop out break even on the underlying. And the reason you have to differentiate that is because options pricing changes based on more things than just the underlying price, right? So if you bought $100, or if you spent $100 on puts on Facebook, and then it traded down, and then an hour later came back up to where you entered, it'd probably be worth a little bit less just because of IV and because of potentially spreads and potentially theta cost, depending on when the contract expires. And then we also have break even on the options price, which would mean if you bought $100 worth, or put on Facebook that's worth $100, and it came back to $100, you would stop out break even on the options price. And when it comes to trend based, there's going to be many ways to do it. You can use it doing market structure or using indicators. Personally, I use an ATR trailing stop, which all that is going to be an average true range of the previous candles, which means if the last 5 candles traded up and down about $1, it would trail price about $1 under the last candle's close, which I know it sounds a little confusing, but I'll show you a couple charts and hopefully it'll make sense. But ATR, parabolic SAR, EMA, SMA, Ichimoku, clouds, or whatever you like, it's completely up to you. I personally just use ATR. And then we have the different types of risk, which it's going to be just based on time frame when it comes to the Strat. So this can go daily, weekly, monthly, quarterly, or it could be a 5-minute, 15-minute, 30-minute, 60-minute. Any of the time frames, that's the risk that we'd be assuming, and this will make a lot more sense once we get to the next slide. And then we also have different types of trails, which you can trail up based on the daily, weekly, monthly, or the 5, 15, 30, 60-minute time frames. And it would just be an example of trailing. So the lingo, very, very simple, should make sense. And now when talking about assuming like daily, weekly, monthly risk, when talking about the Strat, this is what I'm talking about. So if you're taking a daily signal, which in this example, this is a daily signal, daily risk would be based off of that previous daily candle or the high of day on the candle you took the trigger on. So in this example, the tight stop would be a high of day risk, which would be assuming daily risk. A medium stop or slightly looser would be a 50% rule. So 50% of that previous candle's range, the candle you're taking a trigger on, that would be a 50% rule risk. So an entry at the orange and a stop at the 50%. And then a trend-based risk on the daily time frame would just be using that previous day's high. And the reason is because if we take out the previous day's low, trade higher and create a lower high, and then continue trading lower, you're trading the trend lower, right? So you're entering here, and if it trades any higher to here and continues, that's still keeping you in that position. It's going to be the widest amount of risk and not one that I use very frequently. But if you're trying to catch low a day or high a day based off of a certain signal on a 5, 15, 30-minute time frame, trend-based risk is going to be your best bet of staying in that position. So now we have the different types of models. And the first thing you'll notice is there's 2 3s. And the reason is because ICT and Strat are slightly different, especially with the way that people are using it. So it's going to be a slightly different rendition. But simply put, they're all going to have a T1 and a T2, and the T1 and T2 normally are going to be static unless it's a trailed position. And if it's a trailed position, the T2 is just your trailing stop telling you to get out. And the 3, when it comes to strat and options trading, that's where you're going to have a slight difference. It's going to be a rolling of the position, and you're going to have a static T2 where you let the trend take it lower, but you use a rolled position to mitigate your risk, which will make a lot more sense when we kind of get into it. And then at the very bottom, we have market structure-based trailing stops. And this is where the trend-based stop up here is going to make a lot more sense, because on a lower time frame, you'll kind of see what I'm talking about. So we will get into that towards the end, but it's not too hard to understand. So anyways, we'll get into the entry or the risk management model number 1. And this is going to be an entry with a T1 giving you break-even stops. And this is going to be static. And all static means is that we know our target before taking our entry. Oops. And if we know it before taking our entry, it does not change. So we would be taking daily trigger, and we'd using daily risk, which is that high of day or previous day's open. They're around the same price point, but we just talked about it. It should make sense. And your T1 static, it would be your first daily magnitude, or your daily magnitude, your first target. And that would be right here on the daily chart with a 2 up, 2 down reversal. The second we hit that, that's your first target. And when you have time frame continuity, meaning this is trying to go outside week, you can't really see it on the chart, but we had previous weekly highs up here. And on Monday, we took out those previous weekly highs. Tuesday, we came down. And then Wednesday, we set up an actual signal. Thursday, we came in and had an actual signal on the daily to take us to weekly magnitude, which is right here, that previous week's low. So we'd be taking daily magnitude as our T1, moving our stops to break even to manage our risk, because we know if prices trade through this trigger, hit our first target, and we're bright red on the day, it's very unlikely we're going to trade up and hit our entry. So we'd move our stops to break even, because if it's unlikely to happen, why would we not take that risk off, right? And then T2, which is static, this is where we'd close the rest of our position. And you can see on Neo, this is just an example from, this is an example actually from Stream and from the Discord, where we got a 2 up, 2 down short at 2014 right here. And you can see daily target hit 1942, which is right here. And then the last target was down here, which triggered the weekly to the downside. So this is just an example of our Neo trade, and it should make a lot of sense. It's very simple. And now we have T2, or we have number 2, which would be an entry with a target 1 being static. We know it beforehand. And then instead of a break-even stop, we're using a trend-based stop. And then our T2 is just that trail stop, stopping us out of that position. So in this example, this is Roku, and we're looking for it over that previous day's high, 82.75 right here, and that previous day's high on this chart is right down here. So you can see we said the gap filled on Roku and AMC. We're going to look for hammers back to the upside on any lower time frame, a 1, 2, or a 3 minute. And this right here is your 3 minute time frame. So we get a 3 minute hammer, and what do we assume taking that? We assume 3 minute risk, which could either be right here at that previous candle's open, or the 50% rule, which is what I just opted to show here for you guys. And that means if we took this entry and it came down to here, we'd stop out. And where's our first target now? After this entry starts to go. Well, our first target's that daily T1, which is static, and we know it beforehand. And after hitting that, what are we going to do? We're going to use our trend-based stop. And that trend-based stop is shown here with the ATR trailing stop. And with this, it can be done on multiple time frames. You can see a 3 minute entry down here. This is a 1 minute time frame. And when it comes to trailing stops, it's slightly subjective, which I know we all hate that, but it just has to be unless you're going to use a 3 minute trail stop on a 3 minute entry and continue that. If you're going to use a daily entry, you'd use a daily trail stop, which if you're a day trader, it doesn't really make sense. If you're swinging, then sure, it makes a little more sense, but it assumes you a lot more risk to use these types of trailing stops on the higher time frames. So I'd normally aid against that, or choose not to do that, which is where the number 3 model comes in. But you can see we hit T1. This is where we take off 30 to 50% of that position. And then T2 is going to be when we get stopped out of that trend. And that would be shown right here. So it's very, very simple. It should make sense. And we can go on to the next one. We have now number 3. So number 3 is going to be entry with a T1, and it's going to be static. We know it beforehand. And then instead of moving stops to break even or using a trailing stop, this is where we look to swing. We're going to roll a position. And all this means is that we're going to be selling fully out of whatever options we decided to take on that trigger and moving into further dated options with further strikes using profit. And I'll give you some numbers so it makes a little more sense in a second. But then with that, we're going to roll a position and we're just going to target number 2. And you can see there's no actual stop loss rules here because there is no stop. And that's the beauty in rolling into further positions and letting winners run for you. And in this example, you can see 26 put on plug at 0.36. That was at this daily entry short. And where's our first target? Well, we had the previous highs up here and we had the previous lows down here, creating that broadening formation. Hopefully you can see that pretty clearly. Once we hit T1 from daily entry, that's where we'd roll the position. So you can see we got them at 36, filled the full exit of the position at 1.4. So about $100 a contract. For simplicity's sake, we'll just say 100. And then we moved into free runners. Next week's puts, you can see 2 strikes lower, and it's slightly more expensive because there's some more time on those contracts. And you can see what I said here. This is an all or nothing free runner position. Swinging weeklies is higher risk. And this is why I manage the risk the way I do when it comes to swinging positions. So in this example, we had actually monthly magnitude down to here, outside month, and we had a weekly magnitude down to T1. So with those higher time frame magnitudes, we can let the winners run. And doing so, we can now kind of lay out what the trade was. So on plug, I can't remember. I think I took 20 contracts. For simplicity's sake, we'll just say 10. So it was a $360 position. So that $360 position, we'll just say I got a full exit at 1.4 for simplicity's sake. There was a partial taken in there. But if we've spent $360 and then closed the full position at $1,400, we made about $1,000. Now, how do we mitigate our risk to swing into weekly options and get that larger time frame magnitude without actually risking our capital we started with? So let's say you just had $360 in your account and now that is worth 1.4 thousand. Understanding that, we don't want our account value to go anywhere under 360, let alone under like 1,000, right? So with that, what we do is with our profit, about $1,000 profit from here, we would roll into, let's say, 4 or 5 contracts here. And 5 contracts at 85 cents would be just under $500. We'll just say 430 or 400. Let's just say 400 to keep it really simple. So if we only spent $400 going into these contracts and we made over 1,000 on that trade to begin with, then we have $600 profit guaranteed sitting in our account from that trade, even if these contracts went to 0. Which is your risk when swinging weekly options or just swinging options in general that have a low amount of time left on them. And the reason is because you could have this big red day and the news come in overnight, gap up above your entry and just rocket to the highs. And if you had your full position, you'd lose money because those puts would be worth pretty much nothing. So that's why we do this here. And you can see we filled 85 cents. And we wanted to let it run into this target and even further, which I don't have the screen caps there. But you can see I had said, let the winners pay you, looking to see 21 and further, which down here is like around 18, 19 bucks, I believe. But you can see those 85 cent contracts now traded to 2.24 under this low on this day here. And that's where we would close partials of there. And now you can, instead of closing your full profit at T2, you can do the same thing we did at T1 and roll your position. So now you have that $400 position is worth about $1,000. So you milked another 600 something bucks out of that trade, right? Now with that, you can say you got an extra 600 bucks, take half of that, 300 bucks, move it into next week's contracts, $300 worth of them. Let's say it was like 5 contracts and just let those work for you, right? And those would have worked. And this is where we just let those swing trades pay us from our daily entries that have incredibly low risk. And you can see that daily risk is assumed right at that that daily high of that entry. So very simple. I know it's a little bit wordy, but very simple once you get the hang of it. And this is how I manage my swing trades, because I don't like taking swing trade entries because the risk is just too big. There's no reason to take a huge risk entry on a weekly trigger when you can take a nice, perfect setup on a daily into monthly magnitude and assume just this little amount of risk, when on a weekly chart, it would be taking a trigger here with your stop like somewhere up in here, right? So that's why we do it that way. And now we're kind of done with the strat ideas, and we're gonna move on to ICT. So on ICT, the number one is the same exact idea. And this is actually kind of where I built my trade management strategy from ICT, because I just started trading it on futures right when I got out of college, and this made a lot more sense. And it's then how I kind of moved into managing my options positions, at least with very set rules. So on ICT, you can see we were looking for break of structure, a move back into this fair value gap here to that 0.5 retracement to buy it and trade up into that -1 or 1 standard deviation of this range. So where would our T1 be? Well, if we're going to trade lower from here, our T1 is always going to be that previous high. And when it comes to ICT and futures, this is where I'd take around 30% of my position off. So if I was trading with 5 contracts, I would take about 2 contracts off. It'd be 40%, but about 2 contracts off, and I'd let 3 contracts go and run to T2. And you can see, I don't have the screenshot of it actually hitting T2, but I promise you it did. It actually went from 40.30 to 40.80, and I did call that move. But anywho, you're going to have T1 stops break even, T2 all out. Very, very simple. And then 2 and 3, I just mush them into the same slide because they're very simple, are very similar. And it's the same thing as before. T1 static, we know that beforehand because it's that previous high before this pullback and move back up. And then T2 is just trailing your stop. And we can also have something similar, which would be a T1 static, which would again just be that high. And then a trend-based stop, which instead of it actually being the ATR, which would be your trail stop, trend-based, I would say it's your hold to the close rule, which only really applies on super green days. Once you go into lunch and the day is nice and green, and if through lunch it kind of consolidates, it goes sideways, you can see like this, and then just continues, that's in hold to the close rule day because it's aggressively being bought. There's no other entries being given, right? So if you took this entry, took your T1 with your stops to break even, and then kind of let this go into lunch, the second we start moving aggressively higher after lunch, you would say that's a hold to the close rule. Keep your stops at break even, or you can move them up if you'd really like to, or you can trail them and just close when New York closes, and that would be your T2, end of day close position. So ICT, super, super simple, very similar to Strat, but slightly different. And now we can get on to another very simple idea from ICT, which is going to be market structure-based trailing stops. And this is where that daily trend-based stop kind of comes in, which let me just refresh your guys' memory here. Trend-based would be a stop at the high when you're taking an entry into new lows. And the reason that is because we understand that if this was a daily trigger higher and it traded back under the trigger but didn't take out that daily low, it's still holding that uptrend to trade higher, right? So in this example, very simple example, you'd be taking an optimal trade entry after that break of structure. Right here, your initial stop would be at that low because we know markets wants to go higher highs, higher lows, like so. And then once we get a new high broken, you'd trail your stop up to here as your next trend-based stop loss, because if we take out new highs, this low shouldn't get taken out if markets are going to trend to make higher highs and higher lows. And that's a very simple idea of structure. And to make it a tiny bit more complicated, you can bring in Fibonacci's if you'd want to. And the only way I would do that is if you get an OTE down here, you get a secondary OTE, you can move your initial stop up to that low once it takes out that previous high. And then when you get these really short pullbacks where it doesn't even get close to the optimal trade entry or the 0.5, you would keep your stop here as a wider, obviously more risk being assumed on your open winning position. But the reason this happens, or the reason we'd want to do this, is because when we get really shallow pullbacks like this, normally this turns into liquidity. And then later in the day or later in whatever time frame you're looking at, they're going to go and run this liquidity into the optimal trade entry and then trade higher again. So that's a little bit more of a complex idea. And honestly, I don't really use this very often. I'll use it as an entry model to buy under that liquidity in an optimal area, but I won't really use it too often to trail my stops just because I'm a day trader at heart. I would rather, when I see this, secure all of this move from here all the way up to here and move my new stop up here. But just for example, this really kind of shows your ideas. And just to quickly kind of go over again with the market structure and give you some better examples here, we can go to ES. And we'll just go on like an hourly chart. And you can see this. So looking at this larger structure, you can see we had these highs put in, aggressive move higher, optimal trade entry, aggressive move higher again, optimal trade entry, right? And you can see our stops would be moved from here to here, then to here, and you have multiple different entries into here, and then you get another move higher. And these are all T1, and this is also T1. Any entries down here, when it moves above, that's always your T1. And again, any entries down here, moves above here, this is also your T1. So very simple idea of market structure. And you can also see kind of an example of that shallow pullback where you get this aggressive move up, super shallow pullback, trades higher, and then it goes and runs that as liquidity under that previous low, and then continues to trade higher. And if we just go down to like a 15-minute time frame, you can see if we took this whole move as the impulse from way down here, from high to low, this whole aggressive move higher, which I'm going to denote it a little bit clearer for you guys. This would be our big impulse. This is that internal liquidity that was created with that shallow pullback. That liquidity gets ran, and then what happens? Trades higher. Doesn't have any breaks of structure just yet. Then you have another break of structure here, runs more liquidity, but holds that low, which would mean optimal trade entry below liquidity, and then trades higher, right? And what happens again? You get displacement above these previous highs, really big move. So this would be your new range or your new optimal trade entry kind of a price range. And then you'd take that range from low to high, and you'd look for the next optimal trade entry, which would be here with another T1 at the top of that range to continue higher. And you can see again, even on the smaller time frame, trades lower, trades higher, new highs, and you'd get the exact same optimal trade entry. Doesn't break the low because we know trending markets, if they're going to break highs, this low should be protected, and we should look for it to continue into those highs. And you can see that like so. Then you get a 2 standard deviations move. But I'm going to cut myself off here. Hopefully this video was simple and doesn't have to be eye-opening, doesn't have to be crazy, but hopefully it was simple and gave you guys my risk management strategy. And for everyone in Stat, I hope this makes it a lot more simple to manage your positions and understand what I'm doing when I don't exactly specify what I'm doing, because I want you guys to understand this and be able to execute it yourself. So if this video wasn't clear enough, there can always be a part 2, and let me know in the comments if that's the case. But I'm going to leave you guys here, and hopefully you guys have a nice rest of your day.